Hi everyone, today we'll be going over accounts, May June 2021, paper 2-3, question number 1. This is structured paper 2, which consists questions of total 90 marks, and we are also given a time limit of 90 minutes. And since question number 1 is of 30 marks, we will be trying and attempting to solve this question under 30 minutes. So without any delay, let's get started. Adam owns a retail business, and he is aware that he must follow certain accounting concepts when preparing his business's financial statements. So firstly, we need to explain how each of the following concepts is applied when preparing a business's financial statements. So the first principle is consistency. We know that the consistency principle requires the business to stick with and follow an accounting method or policy consistently throughout the accounting periods. So we cannot switch up the accounting policies from one accounting period to another accounting period. We have to use and apply the same accounting policies. And this is done so that valid comparisons can be made of the figures in different accounting periods. So let's write that down. Consistency principle requires the business to stick with and follow an accounting method or policy consistently throughout the accounting periods so that valid comparisons can be made of figures. Let's move to the second principle. This is realization. So we know that realization principle requires revenues to be recognized once it is earned, which means that we only record or recognize the revenues once we receive the money. And this is to ensure that the reported profits are based on certainty. Let's write that down. Realization principle requires revenues to be recognized once it is earned. To ensure that the reported profits are based on certainty. Now the third principle is materiality. We know that materiality principle requires significant items to be recorded or reported in detail in a business's financial statements. So these significant items are those which, if not reported, can mislead the parties that are looking at the business's financial statements. So let's write that down as well. Materiality principle requires all significant items to be recorded or reported in detail in a business's financial statements. Alright, this concludes the first part. Let's move on to the second one. We're given additional information. So Adam has completed the trading section of the income statement. However, some errors had been made. If you look at this income statement, we can see that we have reduced the return outwards, which is actually purchase returns from the revenue. This is an error as well. And we can see that we have reduced the return inwards from the purchases. This is actually sales returns. So there's an error right here. And we're also given following informations relating to no record had been made of goods taken for own use by Adam. So this relates to the drawing. And we're given information relating to closing inventory as well. Let's have a look at this question first. We need to calculate a revised figure for gross profit for the year ended 31st December 2020. So we already know that there has been an error in previously made income statement as well, right? So we need to start from the beginning. So we have to start from revenue. And then we have to subtract returns inwards. Let's look for these values in the given information. So revenue has a value of 186,500, whereas return inwards has a value of 2,940. Let's substitute these. For revenue, that was 186,500. For return inwards, that was 2,940. Let's subtract this value and we will get 183,560. All right, now we work towards cost of goods sold. So firstly, there's going to be opening inventory. Then we have purchase. Then we subtract the purchase returns, which is also known as return outwards. All right, first let's look for these three values in the given question. So we have opening inventory of 14,830. We then have purchases of 93,710, and we have purchase returns of 3,180. Let's substitute these three values into our solution. So for opening inventory, I'm going to create another column right here. For opening inventory, the value was 14,830. Purchase had the value of 93,710, and then return outwards to the value 3,180. Let's look for other items. Now we also have carriage inwards. And carriage inwards to the value 730. Let's write that down. Now let's have a look at the additional information given. So first one mentions that there has been no record made of goods taken for own use by Adam. So this is drawings of goods resulting in an amount of 580. So if the owner is taking the goods worth 580, then it reduces the value of the closing inventory by 580. So essentially we need to subtract the drawings in cost of goods sold as well. Let's do that. So we're going to subtract the drawings because it reduces the value of cost of goods sold. And the resulting value mentioned in the question was 580. All right, let's look at the second information. So closing inventory included 14 damaged items, which cost 30. So if these are the damaged items, we can just completely subtract this value from the closing inventory, right? So previously we had the closing inventory 12,670. Then we can subtract the damaged goods value. So that's just going to be 14 times 30. Then 6 of these items cannot be sold. So out of the 14 ones, 6 cannot be sold. Then the remaining item will be 8 items. Now the remaining items could be sold for 35 each. So we can again add the value of those 8 closing inventory with the value 35 to the total value of the closing inventory. So that's going to be plus 8 times 35. But will incur total repairs cost of 56. So for these 8 goods to be sold at a price of 35, there also needs to be repair cost. So repair cost is an expense, right? So we can just deduct the expense. So this will give us the total value of the closing inventory. So that's just 12,670 minus 14 times 30 plus 8 times 35 minus 56, which gives us the value for the closing inventory to be 12,474. Let's substitute this value into the cost of goods sold section. So we always know that the cost of goods sold, we subtract closing inventory value. And we calculated the value to be 12,474. Alright, this concludes the cost of goods sold. Now let's calculate the total value of cost of goods sold. That's going to be 14,830 plus 93,710 minus 3,180 plus 730 minus 580 minus 12,474, which gives 93,036. This needs to be subtracted from the net sales value in order to figure out the gross profit. So we have the net revenue value to be 183,560. Then we subtract the value of cost of goods sold, 93,036, which gives the gross profit to be 90,524. This concludes the second part. Let's move on to the third one. We're given additional information, and the balances were extracted from the books of accounts of Adams Business on 31st December 2020. Alright, let's first have a look at this question. So we need to prepare an income statement for the year ended 31st December 2020. And we need to start the statement with our gross profit figure that we figured out in the second part. Alright, so after the gross profit, there are essentially two sections. So it can either be an income section or it can be an overhead section, right? So first, let's categorize the items given in the information as income or overhead. So discount has the amount 1,580 and it is credit. So the rule of account is that whenever something is given as a credit, it's an income. And if something is given as a debit, that's going to be an expense. So if this discount is an income, this must mean that this discount is received, right? So this is an income. I'm going to denote it with I. Then for furniture and equipment, we just have to depreciate it. Then marketing expenses, obviously this is an overhead. Again, for motor vehicle, we need depreciation as well. Office expense is an overhead as well. Then we have premises. Again, there might be some sort of depreciation here. Now we have provision for doubtful debts at 1st January 2020. This is at opening date. So in case of provision for doubtful debts, we need to figure out the value at the closing date, which is 31st December 2020, and then compare it with the opening balance. If the closing balance is greater than the opening balance, then it will go towards the overhead section. But if the closing balance is less than the opening balance, then it will go towards the income section. In order to compare it, first let's figure out the provision for doubtful debts at 31st December 2020. So provision for doubtful debts is given right here. Should be maintained at 5% of trade receivables. So, okay, I'm just going to write it down right here. Closing provision for doubtful debts. That's just going to be 5%. So we can write it 0.05 of the trade receivables, and trade receivables is given right here. It has a value of 9,800. Let's multiply. Then this gives us the closing provision for doubtful debts as 490. So opening had the value of 530, but the closing has the value of 490, which means that the value has decreased. And whenever there is a decrement in provision for doubtful debts, it is recorded as an income. So I'm going to denote it with I. That's an income. So rent receivable, let's look at rent receivable is given right here as well, of 1,800 for the 3 months in the 28th February 2021 had not been received. So this 1,800 corresponds to the 3 months. So 3 months will be, the first one will be February of 2021, then January of 2021, and December of 2020. And we're making an income statement for the year ended 31st December 2020, meaning that we'll only record the incomes and expenses within the dates of 1st January 2020 and 31st December 2020. So we do not include all the amount for the 3 months. We only include the amount for the month of December, which means only 1 month. So if the 3 months has the rent receivable of 1800, then 1 month will have the value 1800 by 3, which is going to be 600. So this 600, we need to add it to the rent receivable given right here. Let's add a 600. Then we can write it down as an income because it is a receivable. Next one, we have repairs and maintenance. So we have an additional information relating to repairs and maintenance right here. This included a payment of 380 for installation. All right, so installation cost is not a revenue expense. It is actually a capital expenditure. So capital expenditure are those expenses that only occur once, but revenue, those are recurring expenses that may occur monthly or weekly or on any time basis. So since installing, we only have to install the equipment once, this is actually a capital expenditure. This is included in the capital and not in the revenue expenditure. So we have to deduct the amount of 380 from repairs and maintenance. Let's write it down here, minus 380. This will be an overhead. Then this 380 is the amount corresponding to the capital. So we must add it to the cost of equipment. Let's have a look. We have furniture and equipment right here. Let's add the 380 to the cost. Okay. Then we have wages and salaries. Obviously, these are overheads. Let's have a look at the additional information section. A payment of 2000 for a 5-month advertising campaign which began on 1st November 2020 was outstanding. So this amount relates to 5 months. So those 5 months are going to be November 2020, December 2020, January 2021, February 2021, and March 2021. Again, we're making an income statement at the year ended 31st December 2020, which means we will only be recording the expenses till 31st December 2020. So out of these expense of 5 months, we will only be recording those relating to the 2 months. So if 2000 is of 5 months and we need to figure out the expense for 2 months, we can just multiply it with 2 and then divide it with 5, right? This gives us the expense for the 2 months to be 800. And this is in advertising campaign expenses. So advertising can be written down as a marketing expense. So let's just add this amount of 800 to the marketing expense plus 800. Again, let's have a look at the additional information. So we have depreciation for furniture and equipment, 20% per annum using reducing balance method. Let's just figure out depreciation as well. So for reducing balance method, we need to subtract the provision for depreciation till now from the total cost and then multiply it with the rate. Let's figure out the cost is 18,220 plus 380 and the provision for depreciation is 5,370. Let's write that down. So that's going to be 18,220 plus 380 minus 5,370. We'll multiply it with the rate of 20%. So that's 0.20. This gives us the depreciation charge for the year to be 2,646. Let's figure the depreciation charge for premises as well. We need to calculate it using the straight line method, meaning that we only need the cost value and then we have to multiply it with the rate of 2%. Let's figure out the cost first. Cost is given right here at the value of 160,000. So that's just going to be 160,000 into 0.02 because that's 2%. This gives us the depreciation to be 3,200. And then no depreciation is charged on non-current assets in the year of sale. Now, the sixth information we are given is that no record had been made of the sale of the only motor vehicle on 1st December 2020 for 1,350. So this is the value that we received by selling the motor vehicle. Now let's have a look at this motor vehicle information, which is given right here. So we have the cost and we have the provision for depreciation. Let's figure out the net book value. So net book value is just the difference between cost and provision for depreciation. That will be 16,800 minus 13,900. This gives the net book value to be 2,900. Now we can clearly see that we received way lesser amount than the net book value, which means that there has been a loss on disposal. So the loss is just the difference between the net book value and the sales value. We have the net book value to be 2,900. We have the sales value to be 1,350, which gives the loss on disposal to be 1,550. All right, so we calculated everything. Now let's just write it down on our income statement. We will be starting from the gross profit. So we calculated the gross profit in the second part. Let's have a look. So the gross profit was of 90,524. Let's substitute that value. Then we add all of the other incomes. So our first income was discount received. Let's look for the information for the amount. So amount is 1,580. Let's substitute this value. Secondly, we had the decrement in provision for doubtful debts. So we can write it down as decrease in provision for doubtful debts. So we figured the closing balance on provision for doubtful debts to be 490, and we had the opening balance of 530. So the difference between this will act as an income. Let's figure that out. So that's going to be 530 minus 490. That's going to be 40. Now we also had another income of rent receivables. So that's going to be 6,640 plus 600. Let's write that down. So this was 6,640 plus 600, which gives the total rent received to be 7,240. This concludes the income section. So let's just calculate the total for the income by adding these three values. That's going to be 1,580 plus 40 plus 7,240. That gives 8,860. Now we just need to subtract all of the overheads. So the first overhead was marketing expenses. It has a value of 4,850 plus 800. Let's write that down. So that's 4,850 plus 800. This gives the total marketing expenses to be 5,650. Let's look for another overhead. That's going to be office expenses with the value 2,950. Let's write that down. $2,950. Let's look for another overhead. We have repairs and maintenance at 1,970 minus 380. Let's write that down as well. So the value was 1,970 minus 380. This gives the total for repairs and maintenance to be 1,590. Let's look for another overhead. We have wages and salaries at 31,280. Let's write that down. Let's look for another overhead. All right, we already cleared out the first one, second one, third one, fourth one as well. Now we will write down the depreciation. Depreciation for furniture and equipment was 2,646. So this had a value of 2,646. Let's look for the depreciation on premises. It had the value of 3,200. Let's write that down. 3,200. Lastly, we have the loss on sale of motor vehicles. So that's loss on, we can write it down as disposal. Disposal of motor vehicles. Let's look for the value. That was 1,550. Let's write that down. This concludes the overheads. So let's just calculate the total overheads by adding up these 7 values. So that's going to be 5,650 plus 2,950 plus 1,590 plus 31,280 plus 2,646 plus 3,200 plus 1,550. This gives the total overhead to be 48,866. Now we can easily figure out the profit for the year. So we will start with gross profit, then add the total other incomes and subtract the total overheads. That's going to be 90,524 plus 8,860 minus 48,866, which gives the profit to be 50,518. This concludes the third part. Let's move on to the fourth one. We're given additional information. Adam would like to improve his business's profitability, and he has been considering the following proposals. So the first proposal is to reduce inventory levels. Second proposal is to increase the markup by 5% on the current level. Advise Adam which proposal he should choose. We need to justify our answer by considering both proposals. All right, so let's first consider proposal 1. In proposal 1, we are reducing inventory levels, which means we are reducing the inventory held by the company. This obviously reduces the holding cost. So might reduce holding costs. Secondly, we are only storing very minimal amount of inventory, right? So this reduces the risk of obsolescence. So the inventory cannot go to waste because we are not holding a bunch of inventories. We are only holding for what will be required at a certain period of time. So let's write that down as well. Might reduce the risk of obsolescence. Thirdly, due to minimal inventory level, there might have been a limited range of products because we cannot hold a bunch of products, which might limit us to a certain range of products only, which might lead to possible loss of customers because maybe the customers want a variety of products. That might be the third point. Let's write that down. Might have limited range of products leading to possible loss of customers. Now let's consider the second proposal. For second proposal, we are increasing the markup by 5% on the current level. So firstly, we obviously get an increased profit because of the increment in the markup percentage. So increased profit. Secondly, because we are increasing the markup level, it will also increase the sales price, which might result in customers perceiving the goods to be of better quality because higher price might mean better quality to some people. Let's write that down. Increases the sales price, which might result in customers perceiving the goods to be of better quality. Alright, thirdly, higher price may result in loss of customers. Let's write that down as well. Higher price may result in a loss of customers. So considering these factors for both the proposal 1 and proposal 2, I would make a decision to choose proposal 2. Let's write the decision clearly. So the decision will be that Adam should choose proposal 2. So this concludes the fourth part and also the question. If you found this video useful, make sure you leave a like below and leave a comment as well. And make sure you subscribe and hit the bell icon so that you do not miss any of these videos in the future. Thank you.